Hello and welcome to this week's Advisor Fit Finance sessions with myself, Tom Senegals, Henry Elliston and Tim Webb. And this week we are going to discuss what things can I do as a business owner to either be more tax efficient in how I approach running my business, or what are some of the perks and abilities I have and options available to me as a business owner to improve my financial planning. So chaps, which one of you wants to go first?
Don't all shout at once. I'll go first. I'll get the low-hanging fruit and leave Tim with the hard stuff. I suppose the obvious first port of call is pension planning, and as a director of a limited company, makes a lot of sense to try and make sure that you're extracting funds to top up your pension. Not only is it tax efficient in terms of having money in the pension, but from a corporate position as well. It's a sensible way of getting money out of the company accounts. You don't have to pay corporation tax on that money that's paid to you then into your pension. So that's a pretty fundamental first port of call when it comes to tax efficient investments for directors. I think the other thing is, and I've seen this quite a lot over the last few years, are directors building up cash within their company accounts just through excess income, which perhaps then they don't want to draw out. And they might not want to draw it out for a number of reasons, either because they don't actually need the income personally, so why draw it out of the company just to pay income tax on it, or they might be just saving the money inside the company account because they think there's going to be some form of capex down the line that they're saving towards. But as we all know, bank accounts are paying the square root of nothing at the moment. And so a lot of these guys or girls are sitting on this significant cash holdings earning nothing, or 0.1%. And so what I've seen is actually we're being able to place some of this money into relatively low risk investment accounts, helping this money grow at least over inflation. So getting some investment return over the medium term. And I suppose for these people, we'd want to have an investment horizon of 3 years at least as a minimum plus. But actually helping their money grow might not be tax efficient because you're going to pay tax on the growth within the portfolio because you can't wrap it within an ISA, for example. But certainly it's a way of trying to encourage some positive returns from money that's just set aside for no particular future purpose.
Yeah, and I think a lot of business owners don't, particularly with what's gone on over the last year, whilst pension planning is great, and if you're towards the end of your sort of business cycle or approaching retirement, then that's a lot easier. But if you are building up these cash balances and want to do something with it that's a bit smarter, then that gives you the account again, and those portfolios we can release in sort of 2 weeks time, or run different tranches of money for different timeframes. Tim, what about what sort of areas of, if you are maybe younger and you've got a business and you want to protect your family, what could you do as a business owner to help there?
Yeah, well, of course, most people out there have life insurance, or at least have heard of life insurance, and but those who have a company as well, what they may or may not be aware of is that actually more often than not, you can put the cost of that life insurance through the business. It's not labelled or technically the same policy as one that you pay personally. So if you're just an employee, for example, what we can effectively do is set up a mini death in service scheme for the directors of the policy, or just yourself if it's just a one-man band type scenario, where effectively the company pays for death in service benefits, which is effectively just life cover, and the cost of which is deductible again against companies' account service. You get corporation tax off that, and then we'll pay into trust or via a trust on death for the benefit of the director's family. So again, rather than having to pay the premiums out of your net money that you already pay tax on, you can put that within the business and save yourself some pounds and pence there.
We've definitely seen a big uptick this year in people wanting to protect their families, but also protecting the business itself. if the director isn't there, they may want the business to continue, or they've got a really strong team and they wouldn't want the business to collapse thereafter, even if the family got the value of the shareholding. Sometimes having key man cover or critical illness and for key members of the business is always useful and allows a lot more continuity. Great, chaps. Thanks very much for listening, and we'll speak to you next time.